Good afternoon. I'm Carl Grassi, president of the law firm of McDonald Hopkins. I'm happy to have all of you here today in our audience here in Cleveland and all of you viewing by webcast. Today's discussion and topic is peering over the fiscal cliff, the post-election kind of analysis as what does this mean to businesses, taxpayers in general, what planning can we consider now in light of the developments that are going on in Congress as we speak. With me today are my members of my firm. To my far right, Jeff Consolo. Jeff leads our estate planning practice, and he'll be discussing today some of the estate planning implications to the looming fiscal cliff crisis. To my immediate right is Toni Pilsner. Toni is in our benefits practice. She'll be speaking a little bit about the Affordable Care Act, what it means there, and some of the benefits issues as well in light of the recent developments in post-election. To my immediate left is Mark Klimek. Mark is a member and leads our tax practice group. He'll be discussing some of the issues of some of the provisions of the Bush tax cuts that will be expiring. And to my far left is Mike Wise. Mike is a member of our government relations group. Mike will be speaking to some of the issues facing government. Will this fiscal cliff be solved? In addition, Mike co-chairs our energy practice. He'll talk a little bit about renewable energies and energy in general in light of the recent election. With that, I'd like to get started. If any of you in the audience have a question, there will be cards for you to fill out. Submit them to any of the people on the end here, and we'll answer those questions as we go along. Those of you that are watching by webcast today, there should be a link on that webcast where you can click on that link, ask the question, and we will make a point to answer those questions time permitting. We look to close the program by 1 today, 1 p.m. Eastern Standard Time. To the extent we do not get to all the questions, we'll make sure that we'll follow up with those individuals as to the resolution or answer to those questions, to the extent we have them, frankly. With that in mind, I'd like to start with Mike Wise. Mike, obviously last week we had the election. There's a lot of discussion going on as to what the fiscal crisis means, and what resolution will happen in this lame duck session. Briefly, if you could, maybe just summarize what does the election mean? What did that election mean in terms of, in essence, nothing really changed, so to speak. We still have a House that's represented, majority represented by the Republicans. The Senate is majority representation by the Senate, and the President obviously remains in office. But with that in mind, there have been some subtle differences and unique issues or considerations that are going. So for you, what do you see it meaning to us?
Well, thanks, Carl, and good afternoon, everybody. I think everybody right now is really trying to measure the extent of the victory. It was clearly a very significant victory for the Democratic Party and obviously for the President. As Carl mentioned, the House did stay Republican, but the Democrats picked up seats. In the Senate stayed Democrat, but the Democrat picked up seats in the U.S. Senate as well. What's interesting is Obama, there was 6 swing states that were really critical, and Obama would say, I've got a mandate, I won all 6 of those swing states. The one state that some would argue that he didn't win was North Carolina, but many of the pundits would say that that's not a swing state. So he wins all 6 swing states. You have all those pickups. He would argue that he has a mandate and he can aggressively pursue his agenda. You also look at some of the demographic swings that people are talking about, in particular the Hispanic vote and the vote out of the urban areas. I was sitting watching the election returns and I got a call from somebody in Cleveland and they said, my gosh, I'm looking at 6 precincts and the victory total in those 6 precincts is 2,200 to 4 for President Obama. There's got to be a problem. And my response was, there's not a problem. That's pretty much how it goes in the city of Cleveland. Well, then we find out after the election, for those of you that are looking at returns around the country, you've got a situation in Philadelphia where it's tens of thousands to 0. And so, is this a demographic switch or not? Some in the Republican Party think it is, and that's why you saw yesterday, Rubio and Hatch and McCain come out with immigration reform. But other people say, no, this is an anomaly. The Electoral College is still solid Republican. Obama is the anomaly. Clinton was the anomaly, but the demographics are still solidly Republican. So I think we're going to see that play out here over the next 6 weeks or so as the Republicans argue that we should stay the course and stick with what's been successful for us for the last 30 years. And you'll have Obama argue, no, there's been a sea change and we need to do things differently. And my approach was rationalized or vindicated in the election. And that's the approach that we're going to lead with. And we saw that, I think, even yesterday when Obama came out and said, we're not going to be looking for $800 million or $800 billion in cuts. We're going to look for $1.6 billion in revenue increases. So, I guess, Carl, I see, the next couple weeks, people are going to be firming up their positions as far as how they view the election. And then we'll have really the foundation for what kind of deal, whether it is going to be the grand bargain or whether it's going to be something incremental.
Yeah, and we know the president made 3 points very clear last week when he met with the public shortly after the election with his news conference. And the couple things he said was he was going to go to the American people. He was going to go to CEOs, which he's meeting with today, business leaders, and he was also meeting with the unions and finding out what they would like, and ultimately was going to go to the American people because he felt he had a mandate. And John Boehner, in his speech shortly thereafter, indicated that he was going to try to work, did not want to set any boundaries in terms of what's on the table or not on the table with the looming fiscal cliff, looking to compromise. And as everyone's reading the papers today, it's not certain whether or not we're going to reach a resolution in this lame duck session. Will we fall into where the fiscal cliff will in fact happen? These tax cuts, Bush tax cuts will expire, and we'll be addressing this next year. Possibly the idea of kicking the can down the road. What does that mean? And the uncertainty it means for business, and the impact in general, what it means for our economy. And with that, I think one of the things that I think is important for today's discussion is we can't predict, no one really can predict what's going to happen in the next 7 weeks or so, or really what's going to happen after that. We're seeing obviously a lot of things being floated about. People are drawing lines in the sand, kind of setting their terms, but businesses in general have to work in this environment. And what we do know with certainty to some degree is what's currently in play today. And what are some of the things that business owners and businesses in general should be thinking about, so that they're not waiting for this idea of what happens next. As we know, a lot of businesses are talking about not making any significant decisions in terms of hiring, capital expenditures, waiting for this, looking at this now as a bigger issue than, frankly, Europe for many of them, because they're not certain of what to do. And we've got a lot of companies and taxpayers out there sitting almost on the sidelines. And we know by December 31st, something is going to happen. Either there's going to be no agreement or the Bush tax cuts are going to be gone. And kind of with that, Mark, I'd like to talk briefly about some of the highlights of some of the things that business owners should be thinking about, businesses first, maybe, and we can talk a little bit later about individuals, in terms of what they should be thinking about right now if, for example, it's year end, in terms of planning purposes. What are some of the things that are going to be expiring under the Bush tax cuts that businesses should be thinking about taking advantage of right now?
Well, Carl, there's a multitude of things that businesses need to be thinking about, both in terms of deductions for the business as well as the impact on the shareholders of an increase in tax rates. Everybody's probably seen plenty of media coverage of the increase in rates, and I think it's helpful to take those rates one at a time. So let's talk about the increase in ordinary income rates. And we know most smaller, closely held businesses are operated as some type of pass-through, so that the income of the company is passed through to the shareholder, paid by the shareholder. And those rates are going up, back up to 39.6% if something isn't done by the end of the year. And so if you just look at that, you would say, well, do I want to continue to be a pass-through? Corporate rates are not slated to go up at this point, and in fact, there's a lot of talk about reducing tax rates on corporations, on C corporations. And so if you were an LLC or an S corporation, do you say, well, maybe I want to be a C corporation. I don't want to pay these higher taxes. I can usually convert an S corp to a C corporation. I can usually convert an LLC to a C corporation. But it's not that simple, because then you have to look at the increase in other taxes and most importantly, the dividend rate. That's the most significant increase of all the potential Bush tax cut expirations And you're talking about a dividend rate right now of 15% going up to 39.6% taxed as ordinary income. And then you add on the 3.8% Medicare tax and add on the phase out of itemized deductions, and you get up to a tax rate on dividends, even without state and local taxes, that's 45% or more. And so as a business owner, you think, well, do I make the election to be treated as a C corporation? I'll pay lower taxes on my business income, but getting that income out of the company, now I'm going to be paying 45% or more dividend to get that out. And it's really, as you said, Carl, a prediction. If we knew exactly what was going to happen with tax rates, we could tell clients exactly how they should structure their business going forward. Unfortunately, we don't know that, but I do think that, as you said, what we do know right now is that if nothing is done, these rates are going up.
And I think it depends on the entity that you are, as you said, because a C corporation, as we know, is where it pays the taxes. Typically, larger corporations operate as a C corporation. And the issue that they're facing in terms of the discussion is they're talking about overall tax reform to lower C corporation tax rates. And that's been pretty much bipartisan support in terms of we should become more competitive worldwide in that regard. So the idea of some sort of accelerating income on behalf of a C corporation really doesn't make necessarily a lot of sense. However, there are some other provisions that are going to affect C corp, the expiration of certain bonus depreciation, some other elements, and in terms of what they want to do. But when I'm talking to a lot of business owners, particularly the ones at the C corp level and the S corp level, the concern is, are we going to be in a recession next year? If this fiscal cliff hits, so I'm holding back on my capital expenditures, I'm holding back on my hiring until we have some clarity here. And in addition, when you tie that into the Affordable Care Act, which we know many people in Romney ran on the platform, I'm going to repeal it, it's pretty clear now that
It's not going anywhere.
it's not going anywhere.
No.
So in that regard, what do businesses should be thinking about in that context with?
Well, and as you said, it's from a legislative perspective, it's not going anywhere. There's obviously no appetite from the President and the Senate to repeal it, and even John Boehner said it's the law of the land. The items that are coming into play in 2013 are fairly minor. They're the flexible spending account limits. There's the Medicare surtax on wages that employers are going to have to do. We're not going to be seeing the non-discrimination rules probably until 2014. The IRS has said they're second on the list, and if they're going to give you 6 months notice, so if those aren't out by the end of June 2013, they're not going to hit for 2014 either. But it's the employer mandate coming into play in 2014 that employers are going to start thinking about in 2013, because your population and your workforce in 2013 is going to be affecting whether or not you're subject to it in 2014. And the big, probably one of the biggest ability that an employer has to work with that is the fact that you only pay penalties on your full-time employees, and only if you have more than 30 full-time employees. So a lot of employers are looking at that 30-hour-a-week threshold. You've already heard, I think, the Olive Garden and a couple of other employers are saying, we're going to cut back. Everybody's going to be less than 30 hours because we don't want to be subject to that mandate. There can be logistical problems with that. There's obviously, recruiting and retention issues. If somebody wants a full-time job, they're not going to be looking for part-time work, but can your business function with only part-time employees? It's not just the same, because the 30-hour-a-week requirement is done on a look-back basis. It's actual hours worked. Whether or not you say they're only going to be scheduled for 30, but then they end up working 40, that's going to come into play in determining whether or not they're 30-hour-a-week employees and whether or not you're going to have to provide them health insurance or pay the penalty.
And Tony, that's really important, because you're hearing a lot of companies, such as the retail, restaurant establishments, the hotel industry, that have bought software to really focus in on scheduling. This was something that was very difficult to do when you had a lot of different part-time employees now trying to keep it under 30 hours. The one thing to keep in mind is the look back.
Right.
So you could have a group of employees that you think are less than 30, but they get busy, they work them overtime, they do other things that actually run afoul of that rule.
Correct. I mean, there's a concept called a look back and a stability. So you get a period of up 3 months up to 12 months to determine if somebody is full-time based on their actual hours. And then you have to apply that determination for what's called a stability period, which is a period of 6 months to 12 months. You can't change their determination. But then you have to, when you end that stability period, so say you're going to look back for all of 2013 to determine if somebody's full-time employee 30 hours a week for 2014. Well, you have to treat them as a full-time employee or not a full-time employee for all of your stability period and say you pick all of 2014, but then you have to look at their all their hours they work in 2014 to decide if they're full-time for 2015. And it's always going to be look back on an actual basis. It's a look back, so you're not going to have to be doing it every month. You're going to have a period of time where you know if somebody's full-time, you know if somebody's not full-time. But you're going to have to keep redetermining that on actual hours worked. So it's not as easy as saying you're only going to schedule people for 29 hours and then they all end up working 32, 33, 35.
Right.
There's also the issue of, is it really more cost effective to have, take every job and split it up into 2 jobs? Now you have double FICA, you have double other workers' comp premiums, you have double other expenses when you have more people on the payroll. So there's a lot of expenses to balance. It seems to be it's the employers who are not currently providing health insurance at all who are really looking at this route, because anybody who already has already taken on an expense to provide a benefit they don't have to provide, and so now it becomes what's the incremental expense versus paying the penalty. But it's something that you've got all of 2013 to look at this and start seeing what your employee trends are and determining who's your full-time people who will be affected by that penalty or who will be subject to that for whom you'll be subject to that penalty in 2014.
Okay. Michael, when in terms of some of the considerations that we have here, who are the winners and losers in business? What industries do you see in light of President Obama's victory and the majority in the Senate? Who do you see as the winners? We've talked a little about Affordable Care Act. We know that's not going to be repealed. What are some other areas where you see winners and losers in that space?
Right. Well, I mean, clear loser is going to be the defense industry. I mean, there's no cuts were coming as it was. Cuts were going to come even if Governor Romney won. Those cuts are going to be more significant. Even without sequestration, those cuts are going to be very significant. Those of us in the Cleveland area, we look at NASA as being a very important entity, and NASA doesn't have a champion really anywhere. So we could be looking at more cuts for NASA as well. It was interesting. I maybe take a different view of the energy industry, and this was echoed yesterday. The head of the American Petroleum Institute gave a speech, and he said, what, energy was a winner on Election Day. And I'm sure a lot of people are wondering, why is that? President Obama was never a friend of oil and gas. But, I'll tell you, if you look back at the 2 candidates, with all due respect to Governor Romney, there really wasn't an energy policy there. It was, let's open up federal lands for drilling, let's do the Keystone pipeline. But beyond that, there wasn't a comprehensive energy plan, where Obama really does and emphasize the fact that we need all sources. All of it is good. And the concern was, would he try to shut down the shale energy opportunity in the United States? And the position of the head of the American Petroleum Institute was, I think we were successful during the election educating the president, and he's become a believer in shale energy. And some of the president's remarks during the campaign seemed to indicate that as well. Now, you had 2 days, I think, after the election, the president took 1.2 million acres out west and said, no drilling on this federal land. And I'm sure people were saying, oh, here we go. But I mean, that's not, listen, that's not what's going to drive shale energy. It's going to be, is the US EPA going to come out with some heavy dose of regulations regarding water usage, for instance, with shale energy? And the hope is that that's not going to take place, and that just wonderful opportunity for the country can proceed forward. Some of you may have seen it. In the next 10 years, it's projected that the United States will be not only the leading natural gas producer in the world, but will be the leading petroleum producer in the world in the next 10 years. And in the next 10 years, North America will be energy independent. Nobody would have dreamed about that 10 years ago. But technology with shale energy is potentially going to bring that to reality. So this is a wonderful era for American energy. And we'll see on the edges, Carl, whether there is regulation that eats away at that, but right now people are very optimistic.
But one thing you could expect, I mean, we know President Obama's policies on various regulatory matters. We could expect that those are going to continue. In one particular area today, or yesterday it was announced that the Foreign Corrupt Practices Act is going to continue to have intense regulatory scrutiny, and there were guidelines that were issued today. So you could expect for businesses such that you may represent, be part of, and doing business overseas and doing business with foreign countries and individuals overseas, the issue about the Foreign Corrupt Practices Act matter where bribery or something that's facilitating, which they tried to accept out, those kinds of things are going to be big issues and going to continue to be big issues, because anybody that, if you're ever looking to potentially sell your business down the road and that issue rears its ugly head, it will cause a pullback because of the potential liability and the exposure. You mentioned environmental is another area. Wage and hour is another area where you could expect higher regulatory scrutiny as we continue to go forward, as these policies will continue to move forward in terms of the environment. In the tax area as well, you could expect that. And one thing that C corporations might want to be thinking about, particularly now at year end, whether you're public or private, is paying out some meaningful dividends. It's probably likely that the dividend rate is going to go up. One provision that many companies often overlook, but you could expect to see this, is companies can't technically hoard cash. A C corporation is not really entitled to it. They can hoard it to the extent that they think they need it down the road for capital expenditures otherwise. There's something out there called the accumulated earnings tax, Mark. It's been there for as long as I've been practicing.
As long as I've been practicing.
And the thought is, if you've got that issue because you're sitting on a lot of cash and next year comes about and you're unwilling to deploy that cash, you could expect some of these old rules that the IRS has not really been looking to enforce in terms of garnering additional revenues for the federal government are going to be more aggressive on.
Right.
And I'm bringing that up to your...
Well, you already mentioned that companies, as a result of the uncertain economy, have been hoarding cash, and that's no secret. And as a result of that, the IRS has already focused more on this excess accumulated earnings issue, where they can impose a tax on that year's accumulation of cash that isn't paid out as a dividend or as some other expense. You combine that with the fact that if dividend rates go up, the tax on excess accumulated earnings also goes up significantly. And so there will be more focus on that. So you can't, if you are a C corporation, you can't think, well, I just, the big increase in taxes in the dividend rate, I just won't pay any dividends. We're back to the rules we had in the 80s where, companies tried to hoard their cash and face this excess accumulated earnings tax, or they tried to pay out, if the company was closely held and the shareholders were involved in the company, pay out the profits as salary. Then you saw a lot of challenges by the IRS on reasonable compensation. I mean, in the 80s, those types of audits were going on all the time. Haven't seen as much of those lately because the dividend rates are 15%. Companies are more willing to make that distribution at those tax rates. But if these rates do change and the dividend rate goes up to 40 plus, you'll see both reasonable comp challenges, you'll see excess accumulated earnings challenges. It's going to be very difficult for C corporations to manage that cash. And so the idea is, pay out a dividend this year if you can. There was an article in Cranes 2 or 3 weeks ago, basically to the effect that 3 local companies were borrowing a significant amount of money, and about $1 billion of that or so was scheduled to be used to pay a dividend. And there wasn't a lot of detail about the rationale behind the company's decision to do that, but safe to say, I think these companies are thinking in 2 months we're going to see a dividend rate that, if it's not 40+% with all the taxes, it's going to be higher. It's not going to be 15% forever. And so we're going to get this cash out of the company now, pay a significant dividend. Borrowing rates are low, for a credit-worthy company, and so it makes sense to think about getting that cash out right now.
Well, let's take that question, though, because I think this will then apply to S corporations and some of the other issues as well. Here it is, it's the middle of November. The likelihood, banks, I understand, are pretty busy right now with companies that are doing dividend recaps, selling businesses, refinancing, doing a lot of those things, and somewhat you'll hear is, you're kind of late to the party, so to speak. What are some of the things that, if you want to take advantage of, whether you're a C Corp, you've built up cash, that's probably pretty easy. You can make a dividend assuming you don't blow your bank covenants. Let's suppose you want to take, you may not have had built up the cash, but you're really trying to strip out value, because if you could strip that value out as a C Corp, and similarly maybe as an S Corp, you're going to be able to take advantage of the lower tax rates. What are some of the things you might be thinking about?
Well, you can have the shareholder finance it, basically, and have the company make a distribution of a promissory note in order to pay the dividend. you're right. This year people have been looking at selling their companies as a way of guaranteeing a low capital gains rates on their exit from the company. It's really too late to come to that party, and
Right.
we're also getting a little bit late to borrow the money. But for companies that don't have cash, a distribution of a promissory note, as long as it doesn't render the company insolvent, would be an acceptable way to make that dividend and really self-finance
Right.
it. There's no installment sale issue. The payment of the dividend with the note is a dividend payment itself. You pay taxes at 2012 lower rates, and so that's an effective way to
So
get
as
the
long
money
as
out.
the receiver of that dividend has at least 15% federal cash to fund that tax payment come April 15th or
Well, that's
whenever.
right, and the dividend could be structured so that 20% of it is in cash and the rest of it is in a note, and give the shareholder enough cash to pay the taxes. And then the shareholder takes all that into income, and subsequent payments on the note would be tax-free.
What about those individuals that may have already sold their business or received some sort of installment note, and these rules kick in, and it's going to be when you receive the proceeds that you're going to be taxed at the then effective capital gains rates? What can they do? Is there anything they can do? Is there anything those that have already done a transaction, waiting on their cash, realize this fiscal cliff is looming, and they want some certainty as to how can I get taxed in today's dollars?
That's a great question, because if you let's say you sold your business this year and you took an installment obligation, you took a note for part of the purchase price, and you're going to get $1 million in 2013 and another $1 million in 2014. And this has come up several times this week with a client who did just that. And the question is, is there any way to make sure that I pay tax on those two $1 million payments on this note at 2012 rates? I don't know what it's going to be in 2013 or 2014. It's going to be higher. And is there any way to accelerate that? The basic rule is when you get an installment obligation, so when you get that note, you can only elect out of installment sale treatment in the year that you get the note. So it's too late to elect out. But there are some other techniques that would allow you to accelerate the tax on those payments into 2012. The first one would be if you could somehow sell the note, if you could find a buyer for the note. It may be that if that note is gifted to children as part of estate planning, that could be a disposition of the note that triggers the tax. Another way would be to use the IRS's rules really against the IRS, meaning if you have an installment obligation and that note is modified in a significant way, so you change the interest rate more than a few basis points, you extend the maturity date, you make other changes, the IRS says, well, wait a minute, that's a exchange of that new, or of the old note for the new note, and we're going to tax it accordingly. And a lot of times in workout situations, that results in cancellation of debt income to the borrower. But in this case, working with the lender, so to speak, to change the terms of those notes in a significant way that it's deemed a sale or exchange of the note, you can trigger that tax
Very
into
interesting.
2012.
Very interesting, because you could take it, that provision was put in place to really capture
That's
those
right.
changes to tax. Here, you're using that provision in an aggressive
Right.
fashion so you can get the
Right.
lower tax rate, which
Well,
I think is
yeah.
significant.
And needless to say, the IRS, throughout history, or as long as I've been practicing, we've been telling people defer, defer, defer. And so all of the IRS rules are designed to keep people from deferring income,
Right.
not accelerate it. And so when we're looking at a situation where we want to accelerate income, we can use some of the other rules to
Right.
try and accomplish
Well,
that.
along those lines, maybe I want to go to Jeff here real quickly. He talked about a gift and gifting this note. We know that there's been some discussion about the gift tax exemption that's out there, the current estate tax exemption, all those various. Not a lot of discussion going on right now. All you're hearing about is tax rates of those over $250,000. Is it kind of fait accompli that we're going to see those issues are going to go away, and that great gift tax exemption that's out there, a little over $5 million per individual, is going away? And if it's so, what should individuals be thinking about today?
I think it is fait accompli. I think it will go away as of January 1st. I was thinking last night that other than 2010 when the estate tax went away if you died that year, which I never thought was a good estate planning technique, this may be the biggest change that I've seen since I've been practicing. There wasn't a lot of talk about the death tax, if you will, during the campaign. I think if you go back to the president's 2012 and 2013 budget suggestions, he's at an exemption of $3.5 to $4 million on the estate tax side. This year you have $5.1 million per spouse, if you will, so you can shield up to $10 million. I think it's clear that's going away. I think what we're likely to see, although I don't know if it will happen in the next 7 or 8 weeks, is an exemption for both estate and gift tax going down to $1 million. I do think it will be increased at some point on the estate tax side, but what we'll probably see is back to the 2009 sort of scenario where for estate tax purposes you had a larger estate tax exemption, but for gift tax purposes during life you only had $1 million exemption. So now is the time to make that larger gift if you can afford to do it. There are some interesting techniques where we can still make irrevocable gifts but have them benefit spouses during one or both of their lifetimes. So there are some techniques that can be used, and it doesn't have to be an all or nothing thing. I mean, I have a number of clients that have said, gee, we are not sure we want to give $5 million away, but if you run the numbers, even giving $1 million or $2 million away still provides a pretty significant benefit over the course of someone's lifetime.
Okay, so along those lines, this exemption is here today. It's not there tomorrow. If you're a business owner or you're an individual looking to create passing wealth on to the next generation, we know that techniques that have been used over the past have been family limited partnerships, non-voting stock versus S-stock, minority discounts, valuations, all the things that are attributable to trying to create that event. What if you're not ready yet? What if you're not ready yet to make that decision, but you do have the cash or the wherewithal to make the gift? Do you make the gift now, put it in some sort of trust, or otherwise make it sure that it's a good gift, and those proceeds are then available later on to effectuate that type of succession? So you've captured the $5 million gift tax exemption. It's just you're waiting to when you're ready or prepared to make. Is that planning that?
Yeah, I think it is, Carl, and I think you raise a good point because, again, if you look at some of the president's proposals, they've bandied about trying to eliminate the discounting ability and the transfer leveraging techniques that we've used in the past. It's never really gone anywhere. So that using FLPs, LLCs, we could usually say, okay, if you're going to give corporate stock and you think it's worth $1 million, but to discount that by 25, 35% was not unusual at all, so that you could get more bang for your buck. I think that clearly with the president's proposals now, you're going to see the IRS try and ramp those up and eliminate that leveraging technique. So yeah, if you can afford to give away the cash, if you have that, now is still the time to do that. There are techniques. We're doing a number of spousal lifetime access trusts where you might create an irrevocable trust for your wife, and your wife might do it for you. And the terms of the trust have to be a little bit different, but the idea is that as long as you and your spouse stay on good terms, the idea being that, okay, income generated by one or the other trust can be used for both of you during your lifetime. So some people would say, well, gee, you're really not giving it away. Now, at the death of one spouse, no matter which one it is, then typically that trust may pass to, I'm going to use children as the typical beneficiaries. So then you are giving up, or the couple has given up something. But again, if you play sort of the odds and say, all right, younger couple doing this, everybody lives their life expectancy, so maybe this giving up of income doesn't occur until the couple is 75, 80, 85 years old. Maybe you don't need the income as much at that particular point in time, and so you can't afford to give it away.
Jeff, there's been a technique that's been used over the years where you can gift something away to get out of your estate in some form of trust, but then still be responsible, if you would, for the taxes earned in that trust, sometimes referred to as an intentionally defective grantor trust.
Right.
Are there any worries or considerations that may happen with those trusts? And there
Yeah.
are some things that people need to be thinking about if they have those trusts.
Yeah, that proposal, not everybody has picked up on that, but there's a thought that those trusts are going to go away, and the game or the play, if you will, for people was to, if you had the wherewithal to transfer assets into that type of trust, and then as the grantor, you also had the ability to pay the income tax generated by that trust, you were actually increasing the value of the trust pretty significantly, and it didn't count as a gift. So if a parent put stock in trust for kids, said, I can afford to pay the tax, we can write the trust in such a way that for income tax purposes, the grantor, in my example, the parent is paying the tax. But for estate tax purposes, you took that trust out of the grantor's estate. You were actually getting more bang for your buck without having to worry about the gift tax exemption. Again, that's a technique that is very likely to be eliminated as we go forward.
Individual planning as well, Tony, just for a moment. You have an executive of a corporation, may have outstanding stock options out there. Let's assume for the moment they're non-qualified stock options, so that on the date of exercise, he or she receives a taxable income, wage income, equal to the spread between the value of those shares at the exercise price and the strike price. Should they be thinking about exercising those things today? I mean, all things aside, assuming they've got the cash or the wherewithal, or even if there are SARs or other planning, are there some things they should be thinking about today?
Well, again, we're all presuming that individual tax rates will go up in some manner. So as in any situation where you're expecting, any income you receive in 2013 to be taxed at a higher rate than 2012, yes, to the extent that you can do it, you probably want to exercise them unless you have other reasons you would want to be holding them back, or if they're not worth enough and you think that you're going to get greater value out of them, but you're still going to have the appreciation once you exercise. You're going to have, you're going to lock in what your lower basis is going to be on the stock, and you're going to get the rest of it in capital gains. So hopefully, if these capital gains rates are going to be lower, if you're protecting that going into the future, but certainly, you would have to be able to, again, exercise and be able to pay the tax liability in 2012. One other issue for executives in their performance compensation, most of the time we're dealing with calendar year performance periods that are paid out in the following year. Corporations, do have some leeway even within the parameters of Code Section 162 for performance-based compensation to do some accelerated computations and payouts in 2012. They can do that. They'd have to adopt some changes to their plans and their requirements. But to the extent there's a genuine concern that paying those out in 2013, they're going to be taxed much higher than they are in 2012. There are ways to do that by saying that we can accelerate a prorated portion of it. We have to reduce it for the early payment, but we can pull a lot of it into 2012 as opposed to waiting for all of it in 2013. We've run into this a couple years ago when we thought tax rates were going to go up. It's the same kind of exercise. What can you do? What can you afford to pull in 2012?
Right, keeping in mind all the other rules that may be out there, so making sure the plan documents are appropriately
Right.
reviewed, and giving the benefit to maybe those key executives of allowing that acceleration or paying that dividend this year, or doing some of the things to, in essence, the reverse,
Right.
accelerate income, so to
Right.
speak. Mark, we haven't talked much about S corporations, and I want to just briefly touch on some of the things that individuals might want to be considering. Many S corporations might have started as a C corporation, might have had built up earnings and profits that are locked into the company. What should they be thinking about right now?
Well, S corps that were formerly C corporations should also think about paying a dividend this year to get rid of those, we call it earnings and profits, E&P, that it generated when it was a C corporation. As Carl mentioned, even if I have an S corporation right now, if it was formerly a C corporation, I've got this layer of dividends built in there, and as soon as I distribute out enough cash to eat up my, it's called the accumulated adjustment account, the amount of tax that was, or the amount of income that I've already paid tax on, I'm going to pay tax on those dividends at dividend rates, at whatever rate is in place at the time. So if I think in the next couple of years I'm going to pay out all my AAA, I'm going to start making distributions of my C corporation earnings and profits, I'm going to be paying dividend rates that, again, could be in the 40% range. And so now would be a good time to pay that out. There is an election that an S corporation can make to say this distribution is not a distribution of previously taxed income from the S corporation. This distribution is a dividend of my C corporation earnings and profits.
That's really an important provision, because in the S corporation sense, everybody that knows, aware of it, the taxpayer pays the pro rata income of the S corp, and naturally that increases their AAA, and they eventually get a distribution oftentimes from that corporation to cover those taxes. In this case, if that election is made and that distribution occurs before year end, which is critical,
Right.
before year end, and in fact they've got meet their bank covenants or other considerations that they have, those dollars, you're pulling those out at, yes, you're paying taxes on that distribution at equal to 15%, but you almost get a somewhat, so to speak, a double benefit, because while you're paying taxes, which, you know, arguably how much of a benefit that really is in the long run. But the idea is the income's being taxed at the lower tax brackets for those that would be in this higher bracket over 250,
Oh, that's
plus that dividend's at 15%. So those companies that are out there today should be very close in looking at whether or not they have E&P, because it will matter on the time you eventually sell that corporation. When you sell it and you sell the assets of that corporation, or you will ultimately, a piece of it, when you make the distribution out, typically if the transaction's on a gain basis, you will then capture that dividend piece, because it's a function of your basis, and you will be paying the higher tax on that.
That's right. And the existence of earnings and profits in an S corporation can cause other problems down the road. You can lose your S corporation status if you have earnings and profits and too much of certain types of income. So there's other reasons to get rid of that if you can, and now would be the ideal time, because I don't know what's going to happen with tax rates, but I seriously doubt that 15% dividends will be around much longer.
Right. Another question maybe for you and Tony. There's been a lot of talk that really came up with Governor Romney about closing tax loopholes. What loopholes, as opposed to increasing tax rates. Now, I think if you're reading recent publications and going on, the President Obama and his team have latched onto that, say, yeah, that's a great idea. Let's close some tax loopholes, but let's still increase the tax rates as well.
Yeah, right.
So let's talk a little bit about some of those tax loopholes that might be closing, and is there anything that can be done now to get the best bang on those loopholes?
Well, I'll throw in my 2 cents worth. You know, a lot of bipartisan support is coming for the Bowles-Simpson or Simpson-Bowles plan, however you want to call it. But the essence of that plan was to close any tax loophole, meaning for corporations, no LIFO inventories, no accelerated depreciation, no tax credits. For individuals, it really meant no deductions. The Bowles-Simpson plan had different versions, but one of them had no deduction for mortgage interest, no deduction for charitable contributions. And so I think a lot of people have latched on to this idea of, you know what, we've told everybody that we're not going to increase rates. So let's not increase rates. In fact, Simpson-Bowles had rates decreasing pretty significantly.
Right.
But you're not going to get any deductions for anything as an individual. And for corporations, you know, foreign tax credits, R&D tax credits, accelerated depreciation, LIFO inventories, all those things would be shut down completely. And so I think, you know, the problem is, of course, what if you close those loopholes but leave tax rates where they are, or even increase them? But I'm not sure Romney's plan was real specific on, you know, which of these loopholes were going to be closed. LIFO inventories has always been sort of on the firing line as far as...
There's revenue attached to that, so they know what it would be to shut that down.
Exactly. They pretty much know what that's going to generate. And then I think other sort of unusual industry-specific tax credits, oil and gas, for instance, I think those would also be an issue. But I do believe that a termination of the deductibility of a lot of what, you know, corporations sort of rely on, and individuals, eliminating deductions for, you know, child care and things like that may be a little more safe. But the mortgage interest deduction, charitable contributions, state and local taxes, all those I think are going to be in play.
So barring the AMT issue for individuals, given that there's potentially caps that are going to be put in place on itemized deductions, and they've talked about carving out the charitable piece, taxpayers should be looking to paying those itemized deductions this year to ensure that they're going to get the full benefit barring an AMT hit. So in particular, if someone's selling their business or received a large dividend payment and they've got to pay taxes in Ohio or wherever they might reside, they want to make sure that they make that payment by 12/31.
Well, that's right. And of course, the big problem you mentioned is AMT. Right now, there is no AMT fix in place. And so if nothing happens by the end of the year, and typically, you know, the AMT exemptions expire at the beginning of the year and they fix it by the end of the year. That's what's happened year after year. Well, that hasn't happened yet. And so I thought the projections I saw were that 43 million taxpayers would be paying AMT if this fix isn't put in place. And so you sort of have to weigh the benefit of prepaying or paying some of your itemized deductions by the end of the year with the possibility that you might be diving into a huge AMT tax liability. Now that's something you can wait till the end of the year to do. I mean, you can cut your check on
You
December
mentioned
31st.
bonus depreciation going away, whether for C Corps, S Corps, or individuals, and maybe taking advantage of that. The challenge with that, to some extent, at the moment is you got to have it placed in service by the end of the year. It's just
Right.
not, you can't order it now and get it next year.
Yeah, we're seeing the tail end of all these very liberal rules on expensing. You know, the Section 179 deduction has been huge for years. We've had the bonus depreciation of 50% and 100% of you know, the cost of new property put into service. And some of those provisions expired at the end of last year. We still have 50% bonus depreciation this year. And so and as well as a higher Section 179 deduction. And so if you haven't hit those limits under 179, or a company is thinking about putting property into service in the next year or so, by the end, doing so by the end of this year, if you can do it, would certainly be one way to take advantage of that.
There were a few questions that we have from the audience, and I passed them out to the individuals that I think would be most appropriate to answer those questions. So I'm going to really start quickly. Mike, I'm going to start with you. I think there was a question a little bit on the government
Production tax credit.
Yeah, and you could give some counsel and advice on that.
Right. Well, along with the bonus depreciation, the production tax credit and the investment tax credit and the new market tax credit, those four credits together really have bolstered the renewable energy industry. And the new markets tax credits already expired. There was an allotment, so some companies have been able to access it this year. The 1603, which was the grant portion of the investment tax credit, already expired. The investment tax credit itself is still going to be available for the next 2 years. The production tax credit expires. So unless there's activity, you'll really see, and already the wind industry has definitely cratered this year, but without these tax credits being reauthorized, you will not see robust wind energy activity next year, or frankly, most any renewable energy activity. So it's really critical. Obviously, the White House is very supportive of these extensions. The Senate has been open to it. The U.S. House has been the problem for these tax credits for the renewable industry. That said, AWEA, which is the National Association for Wind Energy, has done a fantastic job educating legislators. And my sense is that at a minimum, we'll see the production tax credit extended in some form going into next year.
Tony, I know you have a couple questions there if you want to briefly just touch on it.
Okay.
Yeah.
The first one is, what are your thoughts on the likelihood of health insurance medical costs skyrocketing due to the change in coverage requirements and the medical device excise tax? There's still push to get the medical device excise tax repealed, but given how we pretty much are where we started from when the Affordable Care Act was adopted, that's not looking as promising, although there's certainly strong arguments that it's going to have a larger impact on that industry than what was originally anticipated. But that's a direct pass-through. The 2.3% is going to be a direct pass-through into the medical costs. But whether or not medical costs or insurance costs are going to skyrocket, it's difficult to say. The idea being that there's more people in the insurance pool generating more income to the insurance companies, but perhaps not using more services. It's difficult to say. Now, medical inflation keeps going up because the cost of technology, the cost of research and development are built into that. But whether or not, the health insurance has been increasing, but there's a number of studies that are saying it's increasing more slowly than it was. And again, you can't control all the factors, but broadening the insurance base, arguably from a theoretical standpoint, should reduce the cost of insurance. Whether or not we're actually going to see it based on how, when the employer mandate and the individual mandates are fully implemented. It's really difficult to say, because it's really not going to be able to control usage. It's going to be controlling who's paying into the system. So there's different parts to that. So it's really hard to say, like I said, from a theoretical standpoint, because there's more people paying into the system, ideally the cost should go down, but we haven't really seen that yet. So it's difficult. I really don't know, because it's difficult to say where we'll actually be in 2014 with all of that. The other question is going to the long-term employees. Has the issue of long-term temp employees been addressed? And I'm guessing this is whether or not they're employees of the temporary agency or they're employees of the service recipient. And anybody who's in that industry knows that who is an employee can be a very complicated issue. Is it just a common law employee? Is it a W-2 employee? And no, there hasn't really been any direct guidance. The understanding right now is that we're dealing with W-2 employees. So long-term temps, as long as they were still on the payroll of the temp agency, would be counted for purposes of the temp agency. But we don't have a clear statement on that yet. We know how to count hours, and we know whether or not somebody's full-time or part-time, but we don't have any clear direction as to whose full-time employee they are. There's been no reference, for example, to the least employee rules. If we're going to adopt those, or if it's just going to be we're going to be counting them based on whose employer ID numbers on their W-2.
Jeff, you have a couple questions, I think?
Yeah, I have one, and I'm not sure I can read it all, but basically it's what's likely to happen with respect to IRAs going to stated beneficiaries in the future. And I think this has always been a tough question for us, because remember that if you have retirement plan benefits of any kind are includable in your estate for estate tax purposes, and they're also going to be income taxable to whoever receives the money. When our exemptions were at $5 million, most people, we didn't have to worry so much about the estate tax implication, and only were concerned about the income tax implication, and so deferring the income over a period of time with lower rates made sense. But if you go back a little bit, where you actually had both the estate tax and the income tax component, which we could get if the exemptions go back down now to $1 million for estate tax purposes. Fundamentally, IRAs or retirement plan benefits, there were times where you actually could theoretically pay more than 100% of the benefit in taxes. But normally we would say at best beneficiaries would get 75 or 80%. When you calculated both the estate and the income tax component, what that leads me to say is we're talking now about people saying with retirement plan benefits, maybe you convert to Roths this year, pay the income tax at a lower rate, and not get into that. Are you making some bets as to what's going to happen with the estate tax component here? Yeah.
But one of the benefits you have, you convert a Roth IRA, or if you can take an in-service distribution into an IRA and convert it to a Roth, you have the ability, as late as October 15th, to reverse that. So depending on what happens, you're kind of hedging your bet, so to speak, as to what the best option would be. So there is some value associated with that. Mark, you got, was there a question I think you might have had on capital gains?
Well, I'll get to the question in a second, but you mentioned the conversion to a Roth IRA, and we really haven't spent much time talking about this Medicare tax on passive investment income, which, as a percentage is pretty significant.
It's going up no matter what.
That's right. This is not part of the Bush tax cuts. This is part of the Affordable Care Act, and it's a 3.8% tax on just about every type of investment income you can imagine, but it's only imposed on people with adjusted gross income over $250,000, and then only to the extent that the income exceeds that $250,000. And the issue with the Roth IRA is that in either case, distributions from traditional IRAs or Roth IRAs are not subject to the 3.8% tax, but distributions from a traditional IRA do count in calculating the adjusted gross income. So it counts as to whether you're hitting that for married filing jointly couples $250,000 that triggers the imposition of the 3.8% tax. Distributions from a Roth IRA do not count toward that. And so if you think your tax situation is going to be such that you're going to be paying this 3.8% Medicare tax, that's just another reason to consider a conversion to a Roth.
Yeah.
Now my question is a good one, and that is basically, Do we see dividend rates going up to the point where they exceed capital gains rates, or are the two rates likely to remain the same, even if they're higher? And it's an interesting question because a lot of the tax simplification plans, including the Simpson-Bowles report and so forth, want to tax dividends, capital gains, everything at the same rate. We're going to have lower rates, much lower rates, but there's not going to be any preferential dividend rate, no preferential capital gains rate. And so looking at that, you would say that there's some chance that they would remain in parity. On the other hand, there's always been a policy reason to have capital gains rates taxed at a lower rate. It's just seen as something that encourages capital investment. We really want to do that, whereas dividends, I think, at least in today's climate, are seen as more likely to be earned by the wealthy, and so we want to make sure we tax those at the highest rate possible. It's an interesting question because right now, with the rates being the same, we don't care that much about some of the planning that goes on to make sure that, for instance, a transaction is treated as a capital gain and not a dividend, and that comes up in the case of a redemption. So we mentioned the possibility of paying out a significant dividend to get cash out of a company, and that makes sense, but a redemption might also make sense, especially if there's only one person who wants to cash out and the other shareholders don't. The problem with a redemption is if you don't redeem all of a person's interest, there's a mathematical test you have to run through to see whether it gets treated as a dividend. Right now, with the rates being the same, there's not that big a difference. You would recover your basis if it's a capital gain. You wouldn't have basis recovery if it's a dividend. But right now, again, under today's law, you may want to consider a redemption if that's something that's going to be done in the next couple of years because of the rates.
We got a few minutes left here. I want to ask a couple of questions. Let's say you're at your end here. You're selling your business. You're looking to sell, and the deal looks like it's not going to close by 12/31. Anything you can do to still capture the capital gains rates here? I'm certain there's obviously risk or considerations. Is there anything you can think about if that should occur?
Well, if you're selling your company, obviously the idea is, to get the deal done. And I think, things that come to mind are, well, why isn't this getting done? Is it a, protracted negotiation and we just can't agree to something? It may be that structuring the deal with a lower purchase price, but an earn-out may get the buyer over whatever hurdles are causing the deal not to get done. Now, again, if you take an earn-out, that's normally reported on the installment sale basis, so you wouldn't report those payments until you receive them. So you'd have to elect out of the installment sale method to take all that income into income in 2012.
And the risk is you may not get that.
That's
income.
right. Yeah, that's exactly right. But that is something that people will definitely be facing. There will be a fair amount of backdating documents, is my guess. You got to be aware of, there's all sorts of things that are going to show the transaction happening in 2013, bank transfers, wire transfers, and so forth.
That
you
is so important.
You have to be careful.
Well, along those lines is, some people say, well, if I simply transfer the stock certificate or I transfer the assets, the bills, it's when the benefits and burdens of ownership shifts.
That's right.
That's the test. And the other thing that some people say, well, how about if we just determine the purchase price later? Well, the theory is, was there a benefits and burden shift to the ownership of that company? And secondly, the argument that Service could make is that's an open transaction. That is so material to the deal that you can't possibly shift the benefits and burdens of ownership without having that circled. So we will tax that when the transaction has certainty, and that will be viewed as an open transaction. So the best answer is get the deal done. So that you don't run into those kinds of issues.
Well, again, fortunately, the rules are geared toward keeping people from deferring income, not accelerating it. And so there are some opportunities to do that, but you have to be careful about not documenting something that didn't happen.
Absolutely. Any other questions that we have, or is that? I think that I'm trying to see. Why don't we send this an email because we're almost done, and this is a headcount penalty. Maybe this is for you, Tony. If you got a second, I think. As you're looking.
Question: if there's any determination employer headcount penalties with union employees. Benefits are provided through the union and not the employer. I don't know that they've gotten there yet. as a short answer, but I will check into that and follow up on that. But again, we're talking about a union-provided plan, and that's going to probably, my guess is going to be that there may again be exceptions for collectively bargained arrangements like there have been historically when the IRS recognizes that you're going to negotiate something. And if you've negotiated that you're going to provide benefits for people over 30 hours and not under 30 hours, there may be an exception. We haven't seen that yet, but historically they've always respected bargaining agreements, especially when the benefits are going to then be provided back by the union. I can't say that for certainty, but I would be expecting, again, like when we come out with the non-discrimination rules, there's going to be a carve-out for collectively bargained, because historically that's how the services recognize those things.
I want to thank everybody for sitting in on this conversation we had today, and certainly the only certainty we have is the certainty we have at the moment. And what happens next year is anybody's guess, but my view is typically the markets will decide, and if that should occur, we should see something, but at this point, the most certainty you have is with the rules we have in place today. Thanks for joining us. We appreciate it.